Stop whatever you're doing right now and lock in for the next few minutes. What I'm about to break down isn't some conspiracy theory or wild speculation. This is real market movement happening right now, and if you miss this, you're going to regret it. Welcome back to MarketPulseUSA. Let's dive in. Last week, something historic happened in the precious metals market, something that hasn't occurred in over 30 years. For the first time since the mid-1990s, central banks around the world now hold more gold in their reserves than US Treasury bonds. Let me say that again. Central banks are choosing gold over dollars. This is a massive shift in global finance. This is the moment when the world's most powerful institutions said, "We don't trust the dollar the way we used to." If you don't understand what this means, you're about to get a very expensive education in monetary policy. So buckle up and let me explain exactly what's happening. For the last 50 plus years, since the Bretton Woods system collapsed back in 1971, the US dollar has been the undisputed global reserve currency. Every country holds dollars in their reserves because they need them for international trade, buying oil, and conducting business worldwide. That's how the system has always worked. But here's the problem that's been building. The US government keeps printing more dollars like there's no tomorrow. The national debt keeps climbing higher and higher. The deficit keeps getting bigger every single year. And the value of each individual dollar keeps going down as a result of all this money printing. So for years now, foreign countries have been getting nervous watching all this happen. They've been watching the US government spend money like crazy. They've been watching the Federal Reserve print trillions of dollars to bail out banks and fund programs. They've watched debt go from $10 trillion to $36 trillion. And they've been asking themselves some very uncomfortable questions. How long can this actually continue? What happens when this whole system finally breaks down? When does confidence snap? So quietly, slowly, over the last few years, these countries have been diversifying their reserves away from dollars and into something else. They've been buying gold like crazy. China's been stacking gold. Russia's been loading up on gold. India, Saudi Arabia, Turkey, Poland, all of them have been accumulating massive amounts of physical gold. And now we've hit that historic milestone where gold reserves exceed US Treasury holdings in central banks for the first time in decades. This is a seismic shift in how global finance operates. This is basically a vote of no confidence in the US dollar's long-term stability. This is the world saying, we don't trust your paper currency anymore. We want something real, something tangible that can't be manipulated. And gold fits that bill perfectly. Gold cannot be printed out of thin air like fiat currency. Gold cannot be inflated away through money creation. Gold is politically neutral. It's not controlled by any single government or central bank. It's not subject to sanctions or asset freezes. And that's exactly what makes it so attractive in today's geopolitical climate. Because, let's be real, the US government has weaponized the dollar as a tool of foreign policy. They froze Russia's dollar reserves when the Ukraine situation started. They've threatened to do the same thing to China if tensions escalate over Taiwan. They use dollar dominance as leverage in international disputes constantly. And the rest of the world is watching this happen, and they're terrified. They're thinking, if the US can freeze Russia's hundreds of billions in dollar reserves with a stroke of a pen, they could do the exact same thing to us tomorrow. So they're getting out while they still can. They're selling US Treasuries and buying gold instead. And this isn't some temporary trend. This is the beginning of the end of dollar dominance, as we've known it for the past half century. The global reserve currency system is fundamentally shifting right before our eyes, and most people aren't even paying attention to it. Now, you might be thinking, okay, that's interesting info about gold and central banks, but what does this have to do with silver? Everything. Absolutely everything. Because if central banks are fleeing the dollar and piling into gold for safety, what do you think private investors are going to do next? What do you think corporations are going to do? What do you think wealthy individuals and family offices are going to do when they see central banks making this move? They're going to follow the smart money. They're going to buy gold, and they're going to buy silver, because silver is basically gold's little brother. Silver is often called the poor man's gold for a reason. It's more affordable, more accessible to regular investors. But here's the key thing most people don't understand. Silver moves way faster than gold when the monetary system is in crisis. Silver can go up 10 times as fast as gold during these periods. And make no mistake about it, we are in a monetary crisis right now as you're watching this video. The people who understand market mechanics and monetary history are buying silver with both hands right now. Which brings us to what happened last week with silver prices that has everyone talking. Silver hit $94 per ounce recently. 94 bucks. That's up from around $30 just 6 months ago. That's a 200+% move in half a year. That's the kind of explosive move that creates serious wealth for people positioned correctly. But then something wild happened overnight in the markets. While Western markets were closed and most Americans were sleeping, the silver price crashed hard. It went from $94 down to around $88 in just a matter of hours. A massive drop happening in the illiquid overnight Asian and European trading sessions when volume is thin and prices can be moved more easily. And this morning when people woke up, when they checked their brokerage accounts and saw that big red number, they panicked. They thought, oh no, the silver rally is over, time to sell and take whatever profits I have left. But that's not actually what happened at all. That overnight crash wasn't a natural market correction. It wasn't profit-taking by smart investors. It was a desperate survival move by the big commercial banks who are massively short silver. Let me explain the situation these banks are in, because once you understand it, everything makes sense. The big banks, we're talking Bank of America, Citigroup, HSBC, JP Morgan, they've been short silver for years. They've sold paper contracts, betting the price would go down, but they don't actually have the physical metal to back up all those contracts. And now the price is exploding higher, and they're losing billions of dollars. Let me give you the actual numbers so you can see how serious this is. According to the latest available data, commercial banks are short approximately 4 billion ounces of silver across all their positions. 4 billion ounces. That's their total short position across all exchanges, all contracts, all derivatives combined. Now do the math with me. At $90 per ounce, what's the total value of that short position? 4 billion ounces times $90 equals $360 billion. $360 billion. That's how much money the banks would owe if they had to close all those positions at current prices. Now let me put that number in perspective for you. The entire market capitalization of Bank of America is around $250 billion. Citigroup is around $120 billion. So if silver stays at 90 or goes to $100, the losses on these short positions could literally exceed the total market value of some banks. They would be insolvent. They would be bankrupt. They would need another massive government bailout just to survive. And trust me, the banks know this reality very well. That's why they're so desperate. That's why they smashed the price overnight when nobody was watching and volume was low. They dumped massive amounts of paper silver contracts into thin overnight markets. They triggered stop-loss orders from retail traders. They forced margin calls on leveraged positions. They created fear and panic deliberately. And they bought themselves a little bit of time. But here's the absolutely critical thing to understand. They did not fix the underlying problem. They just delayed it. Because the fundamentals driving silver higher haven't changed at all. The physical shortage in silver is still very real. The industrial demand is still exploding higher. The vaults are still running empty. And the price is going to come roaring back. And when it does, when silver breaks through 95 and heads toward $100, the banks are going to be in even more trouble than before. Because they just showed their hand. They just proved to everyone paying attention that they're desperate, cornered, and running out of options. And desperate banks do desperate things. Now, let me show you the proof that the physical silver shortage is absolutely real. Because while the paper price was being smashed from 94 down to 88, something very interesting was happening in the physical silver market that most people completely missed. The lease rates went absolutely vertical. Let me explain what lease rates actually are for those who don't know. Well, when someone wants to borrow physical silver, maybe they need metal for industrial manufacturing, or maybe they need it to cover a short position they're stuck in, they have to pay a fee to borrow that metal. That fee is the lease rate. It's basically like an interest rate for borrowing physical silver. In a normal, healthy market with plenty of available silver, the lease rate is very low, maybe 0.5% or 1% per year, because there's plenty of metal sitting in vaults available to borrow. Supply exceeds demand, so rates stay low. But right now, the lease rates are spiking to insane levels. They're hitting 5%, 10%, even 15% in some markets. Some reports show lease rates as high as 20% in certain situations. Why would anyone pay 15 or 20% just to borrow silver for a few months? Because there is literally no physical metal available to borrow anymore. The vaults are empty, the silver is gone, it's been bought up, and the people who desperately need physical silver right now, manufacturers, banks trying to cover short positions, industrial users, they're willing to pay whatever it takes to get their hands on metal. This phenomenon is called backwardation in commodity markets. It's when the spot price right now is higher than the future price months ahead. It's when people want the metal immediately, not in 6 months. They need it now. And backwardation is a massive red flag screaming that there's a serious physical shortage. So while the banks were busy crashing the paper price from 94 to 88 to make it look like the rally was over and scare people into selling, the physical market was screaming the exact opposite message. The lease rates were saying, we can't find actual metal anywhere. We desperately need it, and we'll pay insane rates. This is the disconnect between paper and physical markets. This is the proof that the paper price is manipulated and doesn't reflect physical reality. And this is exactly why the silver rally is not over. It's literally just getting started. The real explosion is still ahead of us, not behind us. Now let me tell you what happened in Shanghai, because this confirms that the endgame is here. Last week, the Shanghai Futures Exchange announced brand new position limits that shocked the market. They're slashing the maximum position size for silver contracts from 7,000 lots down to just 3,000 lots. That's a 57% reduction. Why would a major exchange suddenly cut position limits in half like that? There's only one reason. Because they're running out of physical metal to deliver against contracts. They're seeing delivery requests piling up. They're watching their vaults drain, and they're terrified they won't be able to fulfill their contractual obligations to deliver actual silver. So they're forcing traders to reduce their positions. They're cutting the size of bets that can be placed. They're trying desperately to reduce the demand for physical delivery before the whole system breaks. This is the exchange basically admitting, we can't handle this volume. We need to slow this down before everything collapses. And if you don't think that's massively significant, you're not paying close enough attention. Shanghai is the largest physical silver exchange in the entire world. It's where real price discovery happens, based on actual physical supply and demand. And if Shanghai is running out of metal, that means the global market is running out. This is the endgame scenario playing out in real time. This is the moment when the paper market loses all credibility and control, and the physical market takes over price discovery completely. And when that transition happens, and it will happen, the price is going to absolutely explode to levels most people think are impossible. Now let me address something important. Last week, a rumor started circulating online that got a lot of people worried and confused. People were saying that Rick Rule, one of the most respected investors in the precious metals space for decades, had sold all of his silver, and people started panicking. They were thinking, if Rick Rule is selling, should I be selling too? Does he know something I don't? Let me give you the actual truth, because it's very different from the rumor. Rick Rule did not sell all his silver. He sold 80% of his physical silver position. But here's the key detail everyone's missing. He sold it to take profits and lock in gains. He recouped his initial investment, plus enough to pay the capital gains taxes, and now he's riding the remaining 20% completely on house money with zero risk. At the exact same time, he added to his silver mining stock positions significantly. He bought more shares in silver producers and exploration companies. Why would he do that if he was bearish on silver? Because mining stocks have massive leverage to the silver price. If silver goes from $90 to $150, the miners could go up 300 or 500% or more, way more upside than physical. Rick Rule is not bearish on silver at all. He's de-risking his position strategically and moving into higher leverage plays to maximize potential returns. This is what smart, sophisticated investors do. They take profits when they have huge gains. They lock in their returns. Then they redeploy that capital into opportunities with even more upside potential. So if you saw that rumor about Rick Rule selling silver and you panicked and sold your position, you got played by fear and misinformation, the truth is way more nuanced. And the truth is that even Rick Rule, who's taking some profits, is still very bullish on where silver is headed next. He just moved his exposure from physical to miners strategically. That's not a bearish signal. That's smart risk management from someone who's been doing this successfully for 40 plus years. Learn from the smart money. Don't panic because of incomplete information or rumors designed to shake out weak hands from positions. Now let me tell you about one of the most insane price forecasts I've heard recently. VanEck, a major asset management firm managing billions, just released an updated forecast for the price of gold. And it's absolutely mind-blowing. They're using something called the Jim Sinclair model to calculate fair value. It's named after Jim Sinclair, a legendary gold investor who correctly predicted the massive gold bull market of the 1970s when nobody else saw it coming. The model is actually very simple and elegant. It takes the total money supply, M2, and divides it by the amount of gold held in reserves. The result is the theoretical fair value of gold if gold were to actually back the currency supply the way it used to before 1971. Back in 2007, when Jim Sinclair first updated this model with new data, he predicted gold would eventually go to $5,000 per ounce. At that time, gold was trading around $700. Everyone thought he was absolutely insane, but his logic was mathematically sound. He said, if the government keeps printing money, if the deficit keeps growing, if the debt keeps exploding, eventually they're going to have to devalue the currency. And when they do, they'll need to revalue gold to back the system. And sure enough, gold went from $700 to $1,900 over the next few years. It didn't hit $5,000, but the trend and direction were totally correct. He nailed the bull market. Now in 2026, VanEck has updated that same model with the latest money supply data and debt figures, and the new forecast is absolutely staggering. $184,000 per ounce of gold. $184,000. Not $4,000, not $1,000, but $184,000 per ounce. Let me say that again slowly so it really sinks in. $184,000 per single ounce of gold. How is that even remotely possible? Because the money supply has absolutely exploded since 2007. M2 in the United States alone is now over $21 trillion. And the amount of gold held by the US government is roughly 260 million ounces. If you divide 21 trillion by 260 million, you get approximately 8,000 per ounce. But VanEck isn't just looking at the United States in isolation. They're looking at the entire global money supply and global gold reserves. And when you factor in the whole world, when you run the math on a global basis, the number goes even higher, all the way up to $18,400 per ounce of gold. Now, I'm not sitting here telling you gold is going to $18,400 next month or even next year. I'm not saying it's guaranteed to happen in 2026 or 2027, but I am saying the mathematical logic is sound. The model makes sense. The numbers check out when you run them yourself. And if the monetary system collapses, if the dollar loses its reserve status, if central banks have to reback their currencies with gold to restore confidence, then $18,400 is not only possible, it's actually conservative when you look at how much fiat currency has been created globally in the past decades. And here's where it gets really interesting for silver investors. If gold goes to $18,400 per ounce, where does that put silver? Historically, the gold to silver ratio has averaged around 15 to 1 over centuries. That means for every ounce of gold, you get 15 ounces of silver. They move together, but silver moves faster. If we use that historical 15 to 1 ratio and gold hits $18,400, then silver would be trading at over $12,000 per ounce, $12,000 per ounce. Now, I don't personally think the ratio will get that tight in modern markets. The ratio has been much wider in recent times, usually 60 to 100. But even if the gold to silver ratio stays at 60 to 1, which is where it was recently, then silver at $18,400 gold would still be over $3,000 per ounce. $3,000, that's more than 30 times higher than the current price. 30 times your money if you're holding physical silver right now. So when I tell you that my personal target for silver is $300 or $500 per ounce, I'm not being aggressive or wildly optimistic. I'm actually being pretty conservative based on these models. The VanEck model and the Jim Sinclair methodology suggest the upside could be way, way higher than most people even imagine possible. Now, let me bring this all together so you can see the complete picture clearly. Central banks globally are fleeing the dollar and piling into gold for the first time in 30 years. The big commercial banks are short about 4 billion ounces of silver and facing hundreds of billions in potential losses. Shanghai Exchange just cut position limits by 57% because they're running out of physical metal to deliver. The lease rates for borrowing physical silver are spiking to 15 and 20% because there's no available supply. Rick Rule is moving from physical to mining stocks to capture even more leverage to the upside. And VanEck is forecasting $18,400 gold, which mathematically implies multi-$1,000 silver when you run the ratios. All of these independent data points are telling you the exact same thing. The system is breaking, the old monetary order is collapsing, and hard assets, gold and silver, are the only real safe haven. So, what should you actually do with this information? If you already own physical silver, you hold tight. You don't sell because the price dipped from 94 to 88. You don't sell because you saw some rumor online. You don't sell because some talking head on financial TV says the rally is over. You hold because the fundamentals are screaming. The end game is here, and the price is going to levels that most people literally cannot even imagine right now. If you own paper silver, ETFs, futures contracts, derivatives, you need to seriously consider your counterparty risk in those positions very carefully. Because when the system breaks, when force majeure gets declared, you might get cash settled at $88 while the physical market is trading at $200 or $300. Is that a risk you're willing to take with your wealth? If you don't own any silver yet, you need to buy physical now, not next week or next month. Not when the price dips back to 70 or whenever you think there might be a better entry point. Now, because the window is closing fast, dealers are running out of inventory. Mints are backed up for weeks with orders. Premiums over spot are exploding higher. If you wait too long, you might not be able to get physical at any price. Now let me address the skeptics who think the dip to 88 is the start of a bigger correction. The people saying silver is going back to $75 or $70 and you should wait for that to buy. You're wrong, and here's exactly why you're missing what's really happening in the market. The dip to 88 was not driven by actual market fundamentals changing. It was driven by pure manipulation in thin overnight markets. The banks smashed the price when liquidity was low to save themselves from bankruptcy, but they didn't solve the underlying problem driving silver higher. They just kicked the can down the road a little bit. The physical shortage is still there and getting worse. The industrial demand is still there and growing. The vaults are still empty and draining. Shanghai is still cutting position limits. The lease rates are still spiking. Nothing fundamental has actually changed except the paper price got temporarily manipulated lower overnight. And paper prices can be manipulated in the short term when markets are thin. But physical reality cannot be manipulated. Physics and mathematics don't care about overnight futures dumping. So the price is going to come roaring back. It's going to recover and blow through 94 like it was never even there. And then it's going to head toward $100 per ounce. And that's when the banks are really going to panic hard. Because at 100, their losses aren't manageable anymore with accounting tricks. At 100, they need actual government bailouts to survive. At 100, the system breaks, and we're going to get there. Maybe not today, maybe not next week, but it's coming. The math guarantees it. And when we do hit that level, you're going to be very, very glad you held your physical silver through the volatility. Now let me talk about timing, because people always ask me, when is this going to happen exactly? When is silver hitting 100? When is the force majeure coming? When does the system break? I don't know the exact date. Nobody does. You can't time these things to the day. But I can tell you with high confidence that we are very, very close to major moves. The signs are absolutely everywhere if you know what to look for. Shanghai cutting limits, lease rates spiking, central banks buying gold instead of dollars, banks facing $360 billion in losses. All of these are late-stage endgame signals. My personal guess, and it's just an educated guess based on 15 years of studying these markets, is that we have weeks to maybe a few months. We don't have years left. The system is too fragile. The pressure is too high. Something fundamental is going to break in the financial plumbing. And when it does, the price is going to explode to the upside so fast, it'll make your head spin. So if you're waiting for the perfect time to buy physical, the perfect time is right now. Because by the time it's obvious to everyone else, by the time it's on the front page of every newspaper, it'll be way too late. The metal will be gone from dealers. The price will be $200 or $300, and you'll be kicking yourself for not acting when you had the chance and information. Now let me give you one final thought to end on. The reason the banks are so desperate right now, the reason they smashed the price to 88 in a panic, is because they know what's coming next. They can see the writing on the wall. They know they can't hold the line much longer against physical demand. They know the physical market is going to overwhelm the paper market completely. They know the squeeze is coming and there's nothing they can really do to stop it. And when your opponent is terrified, when they're making desperate moves, that's not the time to fold your cards and run away scared. That's the time to hold strong. That's the time to press your advantage. That's the time to look them in the eye and say, I'm not selling my physical silver no matter what games you play in paper markets. So don't let them shake you out with a $6 overnight dip in thin markets. Don't let them scare you with fake news, rumors, or fear tactics. Don't let them manipulate you with overnight crashes when nobody's watching and volume is low. Hold your physical silver, trust the fundamentals, trust the math, and wait patiently for the inevitable moment when paper markets collapse and physical price takes over completely. Because that moment is coming soon. The central banks buying gold instead of dollars proves it. The Shanghai position limit cuts prove it. The spiking lease rates prove it. The $360 billion in bank losses prove it. All the evidence is screaming the exact same message if you're listening. The system is breaking down, the end game is here, and silver is going to the moon. So hold the line, don't panic, don't sell, and get ready for the ride of your life. This is Market Pulse USA, and I'll see you in the next one. Peace.